Hello, this is the monthly update for the Argonaut Absolute Return Fund, March 2023. Barry, what happened to the markets during the month and how did the fund perform?
Well, Rory, beware the Ides of March. And that's as relevant today for bank CEOs as what it was for Julius Caesar back in Roman times. So they may not have been stabbed in the back by 40 Roman senators, but bank CEOs were betrayed by thousands of depositors who all decided to flee banks at the same time, causing a liquidity crunch, which eventually resulted in three banks, Signature Bank, Silicon Valley, and Credit Suisse, all failing. And the fund benefited from that because it had shorts in those three banks, as well as First National, which also fell by more than 80%. Overall, the fund delivered 6%, and that was also helped by a takeover of Belgian telecoms company Telenet, which the fund held in its long book. So all in all, 4 bank runs and a takeover. We could have had Richard Curtis write the script.
You said on CNBC that the bank liquidity crisis was over, but a new solvency crisis was about to begin. What did you mean by that?
So if we look at what caused the failures of Signature, Silicon Valley, and Credit Suisse, they were all depositor runs on the bank. So a bank will hold assets, which it has to fund through liabilities, and your deposits are your asset, but they're the liabilities also of the bank. And typically, the bank will have just 1 day visibility into holding those liabilities, but those assets the bank will have lent out over much longer time periods. So the problem that the banks had during March was very much a liquidity crisis, in that they couldn't meet withdrawals that the depositors made, either through ATMs, but more likely electronic transfers. And that's why they went bust. Now, the Federal Reserve has done something about that, in that they've got a new repo facility, which is essentially makes the Federal Reserve a more generous lender of last resort, but at a penal rate, to follow Walter Bagehot's dictum. And so here banks could actually pawn their assets at par value, which is typically what they paid for them, instead of the market value. And therefore, it's very generous. It should stop banks running out of liquidity and should probably end the solvency crisis. But on the other hand, because that liquidity comes at a cost, i.e. 5% instead of the rate they're paying on deposits, which has often been nothing, what on average has been just over 1%, it should cause a severe contraction of profitability, in that if you think the average asset yield on US loans and securities for banks is just above 4%, that becomes unprofitable if you're funding that from borrowing from the Federal Reserve at 5%, or you have to pay 5% for deposits to compete with money market funds. So hence now we're moving to a profitability crisis where bank shareholder equity may be impaired by low profitability. And that's why we're moving from a liquidity crisis to a solvency crisis.
So do you think this will develop into a financial crisis like 2008?
It's unlikely, but I'm probably too soon to come to that conclusion. And I think we also have to think about how bank crises are not all the same. So the bank crisis that we had in 1933 and that which we had in 2008 were systemic, and they developed into deflationary busts and global financial crises. Now, it's not clear that this crisis is going to affect every bank, and certainly not the big banks, and therefore that it may not be systemic. So it may well more likely be like the savings and loan crisis that the US experienced in the 1980s, where every year hundreds of banks, small banks would go bust. Their depositors were saved by federal insurance, but their equity holders were wiped out. And that was a crisis not only of liquidity, but of solvency as banks struggled to deal with higher short-term rates for funding against assets which were more long-term in nature. And this may well cause localized credit crunches in economies that have been more affected by this, like California, or in industries which are vulnerable, like real estate. But as yet, it probably won't necessarily cause as big a crisis as what we saw in 2008. But I think there's a caveat to that, in that we saw during the month that central banks are still intent on raising interest rates because we still have very high levels of inflation, and that they're only going to do a U-turn or a pivot on high interest rates after a crisis and not before. Therefore, I think it's wise to assume that this crisis will get worse for investors before it gets better. And rather surprisingly, during the month, the US market was actually up over the month because government bond yields or future interest rates actually fell. But those interest rates fell because the bond market was anticipating weaker economic growth, which of course will be bad for corporate profits and bad for equities. So I think this is unlikely to be a development which is going to be a wholesale good thing for equity markets. Therefore, I think it's appropriate that equity investors exercise some caution over the months ahead.
So how can the fund help investors position for future volatility?
Well, Rory, I think, as we've always said, the absolute return fund is a very good diversifier, and that diversification comes through our short book and our track record over 10 years of demonstrating we've got some ability in picking out good shorts. So, most funds, however good they are in the active management space in equities, will go up and down at the same time as the market, and therefore offer little in return in terms of diversification benefits. And whilst diversification may be the only free lunch in investing, it's important to understand how to achieve good diversification, which can really only be properly achieved by investing in assets that aren't correlated to each other. So if you look at our fund returns, we certainly don't promise to make positive returns every month, although we aspire to it. But what we can say is that our returns will come at different times to the markets and therefore most other funds. And therefore, with the correlation of almost zero to the market, we provide great diversification benefits, which can lower your overall volatility of return without necessarily sacrificing on returns, and indeed probably improving returns. So I think that's how to view our fund, as something that will deliver at different times to everything else in your portfolio.